This is Radio Free Wall Street with Lee Adler, on the web at radiofreewallstreet.fm and wallstreetexaminer.com. Hi everybody, this is Radio Free Wall Street, recorded Friday, July 18th, 2014. I'm Lee Adler. Today I'm going to talk to you a little bit about that midweek sell-off we had and how that fits in with cycle theory. And then I'm also going to take a look at the news on consumer sentiment and the long-term implications of that indicator. And finally, we'll take a look at the liquidity indications and the technical outlook for the next few weeks and months. First, I want to talk about that sell-off we had on Thursday, the 1 point something percent sell-off in the S&P that got everybody all excited and thinking maybe finally the big correction that everyone has been expecting is here. In 1970, J.M. Hurst wrote a book called The Profit Magic of Stock Transaction Timing, which is essentially the Bible of cycle theory. Hurst, after researching tens of thousands of hours of stock prices, which he fed into his IBM mainframe computer, which had less computing power than the the phone in your pocket right now. But he was an aeronautical engineer who studied price motion and came to the conclusion that 22% of price motion is cyclically based, and that news events, particularly geopolitical events, had really no influence on the long-term trend. The trends, he felt, were based on fundamentals. Now, 40-some years later, I still look at that book as the basis of the work that I do. But I think that the thing that Hurst missed was the nature of manipulation of markets by central banks and the importance of liquidity. I think I would replace the term fundamentals driving the market with liquidity driving the market. But one of the things that he did discover and did prove was that geopolitical events, major news events, only had a very brief impact on the market. They had no impact whatsoever on the cycle patterns in force or the long-term trends. So that we have an event such as the shooting down of the Malaysia Airlines flight this week that ostensibly was the reason for the sell-off in the stock market. I think that the important thing to remember is that these events do not have a long-term impact on prices. The trends are going to continue. If the move triggered by the news event is counter trend or counter to the cycle that's in force, then that represents, if it's an uptrend, a buying opportunity. So Thursday's sell-off in that respect turned out once again to be a dip buyer's dream. One of the indicators that I follow in the nightly market updates is the VIX, and I plot that on an inverse scale within cycle boundaries, within wave boundaries that kind of go like this on the chart over the long haul. And a couple of days ago, the VIX hit the outer boundary of both the short-term and intermediate wave, which suggested that a buy was at hand. And short-term, the cycles, the 13-week cycle and the 4-week cycle, were both due for a bottom. So that little sell-off yesterday was quite a bit suspicious in that regard. On the other hand, there were indications that the 6-month cycle, a much more important swing cycle, was topping out. So it was possible that that sell-off did begin the topping process for the 6-month cycle. But in the meantime, the short-term cycles are still due for an upturn, and the uptrend that we've been in is still very much in force. The sell-off came down to the trend area, to the lower line of the channel, and that's exactly where it stopped. And then Friday, we had the big rally off that lower channel. A little bit later on in this program, I'm going to take a look at some of the charts and try to get a handle on whether this is a top or not and how much more upside we may have left in this move. But first, I want to take a look at those consumer sentiment indicators because I think they have some important information for us. And you can follow along with my discussion of this in the article that I posted in the Wall Street Examiner on the free side of the site just on Friday. While the media focuses on the meaningless short-term squiggles in consumer confidence indicators, I like to look at the long-term trend. I like it because U.S. consumers in the aggregate are far better forecasters of markets and the U.S. economy than are the professional economic and financial pundits who are so focused on the meaningless short-term headline numbers. The verdict of consumers has been consistent for the past 16 years. Thumbs down. That matches the decline in real median household income and living standards that most Americans have experienced over that period. It represents the long-term decay of the U.S. economy, an economy that is increasingly structured to benefit only the few at the top while leaving more and more Americans behind. These trends have been promoted by the Fed's policies of ZIRP and QE. The benefits of these policies accrue entirely to bankers, hedge fund operators, and corporate executives who order buybacks of their company's stock to buy the very stock options that they granted to themselves. They shrink their companies, lay off workers, increase the pool of unemployed and underemployed workers, and pressure labor market rates lower in the process. These parasitic policies will, if allowed to play out indefinitely, eventually kill the host, the U.S. economy. The long-term consumer sentiment trend clearly reflects the results of current policy. Consumer sentiment has also had a pattern of more pronounced shorter-term declines as the U.S. stock market topped out in 2000 and 2007. This chart from Briefing.com illustrates both the long-term decline and the negative divergences that have developed at the last two major stock market tops. This measure consists of a couple of useful component indicators which reflect consumer attitudes about current conditions and their feelings about the future. These are then amalgamated into a meaningless composite for headline consumption. I like to focus particularly on the present conditions component because consumers are quite capable of evaluating how things are going right now. Like the rest of us, their predictions about the future are suspect. But the expectations index has also had a knack of foreshadowing major stock market declines. In addition, pessimism about the future has persisted for 16 years, a clear reflection of the reality of life for most Americans. While the long-term trends clearly depict a steady deterioration in the American way, I'm more interested in those year-long negative divergences that have marked the last two major tops. Both the present conditions and expectations indexes reached the long-term downtrend lines in late 2012. In spite of stock prices going on a massive run since then, consumer sentiment has not broken out in similar fashion. It has remained below the long-term trend lines. This shows that the stock market bubble is benefiting only the privileged few. Economic gains are not accruing to the majority. As a technical analyst, I see the inability of these indexes to break out to the upside as a sign that the next big move to the downside in the markets and the economy is merely a matter of time. In 48 years of charting, I have come to see that technical analysis is useful in understanding all kinds of trends, not just in stock and commodity prices as most traders use them, but in economic data as well. Technical analysis helps us to recognize and understand clearly the history of where things have been and where the trends are headed. TA has some predictive ability in regards to the near-term future as well, but its greatest strength is in understanding the past and the present. The all-important present is something that most pundits, with their focus on the short-term headlines, fail to grasp because they lack the proper perspective and clarity about the longer-term trends. The longer perspective in this case is deeply troubling. The shorter-term negative divergences from economic data and stock prices are also a red flag. If these negative trends do not reverse within a few months, and especially if they deepen, they would suggest that the stock market is likely to be forming the same kind of top that it formed in 2000 and 2007. Worse, any downturn today would start from a weaker economic position than either of the two previous bear markets. The financial and economic impacts of a downturn from such a weak position are likely to be devastating. Let's take a look at the charts. This is the what I call the third rail chart that I feature nightly in the market update. And it is so busy up in here with all these crisscrossing trend lines, it's hard to tell what's going on. But I put the latest short-term channel in a light blue color. There's your regression center line there, and the two standard error lines that represent the upper and lower bounds of the normal trend. And as you can see, on Thursday, it sold off right to here, to this trend line, which was just above the longer intermediate term trend line at 1955. So the 1955-1960 area is really an important support area. And then we have a cluster of resistance here around 1980-85. And if they clear that on Monday or Tuesday, then they're in the clear to run to the top of the channel up around 1995. The going should get a little tougher from there. The 6 months cycle projection is stuck at 1985, so that there's no sign in the cycle analysis that the market's going to break out here. And we are in a time window, a little bit early in the window, but nevertheless in that window where the 6 month cycle could top out. If the market pops 1995, then we're looking at 2005 to 2010 in here as the next most likely stopping point for this 6 month cycle top to develop. But I think the greater odds are that we will stay stuck and churn around in this short-term channel here between 1965-70 and 1995 and 2000 over the next couple of weeks. Recall that at the end of the month this month, the end of July, the Treasury will be settling about $70 billion in net new supply, net new notes and bonds at the end of the month. That is a big chunk of paper to hit the market all at once. And the Fed will not be giving any help at that time other than the several billion a week of Treasury purchases, which will be nowhere near sufficient to absorb all of that paper hitting the market. So if the market's going to take a little dump, it's going to be right here around the end of month, around to the end of the month or early in August. In August, Treasury supply should be light again. And even if the Fed does taper QE by another $10 billion, there should be some excess liquidity around. Remember, the Bank of Japan is still adding cash to that pool as well, and it's the same swimmers in that pool, the same primary dealers are trading in both markets. So there should be excess liquidity around in both August and September. If there's going to be any weakness in late July and early August, it's likely to prove temporary. The longer-term cycle projections still point to the 2000 to 2250 area on the 4-year cycle, and even higher than that on the longer-term cycles, with that top being ideally due in 2015. So I don't see any reason yet to expect a crash this year, but maybe those conditions will develop as the Fed brings the QE program to a near halt by the end of this year. They'll still be pumping a little cash into primary dealer accounts in the form of those MBS replacement purchases. But that may not be sufficient to keep the pot boiling. We'll just have to see how the technicals look as we get towards the latter months of this year. So that's the technical and liquidity outlook for this week. So when we put all this information together, what does it suggest? It suggests that in the short run, the market may have a little more upside. We don't know how much. And the risks on the long side are growing, particularly when we look at the long-term trend and how long this trend has been in force without the support of the majority of American consumers. They don't see the benefits of this, and that's not only a long-term danger sign, but it may be a shorter-term danger sign as well. So whatever upside is coming here, I think we have to look at a little skeptically, but by the same token, the trend is still your friend. Until there's clear evidence that that trend is broken, we have to assume that the markets are headed higher. That'll do it for this week. We'll get together again next Friday for posting Friday night or Saturday. Until then, have a great week. Trade sane. If you're on vacation, have a great time, and I'll see you next week. This has been Radio Free Wall Street with Lee Adler. Find this program on the web at radiofreewallstreet.fm or wallstreetexaminer.com.